What's up, everyone? My name is Ale. Welcome back to my world of stocks. Now, as most of you know, BlackRock is the absolute largest asset management company in the entire world, with another beast of a quarter that they just released to the public, which this time topped over $10 trillion of assets under management. Now, for some context, that's more than half of all the GDP of China, the second largest economy in the world. How crazy is that? Well, under the leadership of infamous CEO Larry Fink, BlackRock made some more giant stock purchases in the fourth quarter, which again, we just now got that information released to the public. So in today's video, we'll be running through the top 5 largest purchases that they made. I'm going to give you my own opinion on each one of them, and I'll even rank them from best to worst based on that opinion too. So it's going to be a ton of fun. I love making these videos for you guys. I hope you're enjoying it too. And if you want to support me, then please consider subscribing, because that really helps keep my channel alive. And also thank you to anyone that is supporting me over on Patreon or in the YouTube memberships. That really helps keep this channel alive too, and I really wouldn't be able to do this without you. So from the bottom of my heart, thank you so much. Really means a lot to me. But with all of that said, we've got 5 really interesting big stock purchases to run through here. So let's go ahead and jump straight into the list. All right, now we'll be counting down here from smallest to largest position in the portfolio. And coming in at purchase number 5, well, it's going to be a stock that used to be extremely popular when it first debuted, but really feels like it gets a lot less attention these days. And that is the ride-sharing leader Uber Technologies, ticker symbol UBER or Uber, which only makes up around 0.2% of the overall portfolio, yet it's still worth close to $9 billion after having been increased by a whopping nearly 35% last quarter, which BlackRock has been adding to over time. But when looking at Uber's business here, they of course lead the ride-sharing market with a whopping 75% market share in America in what is essentially a duopoly with Lyft. Now, they also offer Uber Business, which tailors the platform specifically towards companies of any size for all their rides, meals, and local delivery needs around the world. They also own Uber Eats, which is basically Uber, but for getting your food delivered. They have a subscription, they have a subscription service called Uber One, which gives special perks and savings towards Uber and Uber Eats for a $10 monthly membership. And they even own Uber Freight, which tends to be less talked about, but has actually grown to be quite large, with over $18 billion of freight under management in the gigantic logistics market that is actually worth trillions around the world. So I do see a lot of future potential to still be had there, where Uber basically handles all of your supply chain needs and even implements artificial intelligence to improve network and operational efficiencies too. As great as all of this sounds though, there is one glaring problem that I've always felt about Uber, and that is how much money gets sunk into having to pay drivers, which is a big reason why they've historically lost so much money on the bottom line despite having robust revenue growth. An obvious solution, of course, would be autonomous driving, although that would obviously be to the detriment of people's jobs and livelihoods. But that is especially the case considering that that's where all of the long-term growth probably lies, with some analysts projecting that the robo-taxi industry may be worth trillions of dollars in the future. But Uber has had a bit of a shaky experience in this area too. For starters, Uber used to invest heavily towards autonomous flying taxis, what they called Uber Elevate, only to later sell the division off to Joby Aviation, where they instead invested money into that company and now plan to partner with them in the future. The same thing happened with their robotaxi division, which they also sold off to another company called Aurora for $4 billion, where they're now partnering with not just them, but also companies like Waymo, which is a subsidiary of Google, and also Motional, which they signed a 10-year long-term contract with. I'm not saying that these are bad moves necessarily for their business. I actually think it may help improve their profitability, at least in the short term, because it's less money that they have to pour into research and development, which we saw the direct results of last year, where they actually turned a profit for what I believe was the first first time ever. But I also feel that it might limit their long-term growth potential in these markets if they're always having to partner with other companies rather than just raking in all the profits themselves. Not to mention how crowded this market will likely become with not just Google, but also Tesla, other American companies like GM, and even international ones too, especially from China like Baidu. And granted, Uber may still do a great job of competing at a very high level in these growing markets. And even right now, their revenues are still expected to climb by a mid-teens percentage, which is pretty good. But I'm also just not really sure that the stock is, I would say, very affordable right now for the risk that I'd have to take on it. I mean, for one, the stock has nearly doubled since IPO, and while their PEG ratio is actually still pretty good at less than 1, that's really a metric that relies on dependable long-term profit growth, which I don't think is an absolute guarantee for a company like Uber. I think here the regular PE ratios are much more relevant, but Uber happens to trade for around 1 to 200% more expensive than the sector on these metrics. And even if we cut them some slack and look at the much more forgiving price to sales ratio, which should heavily benefit a growing company like Uber, well, even here the valuation is more than 200% more expensive too. So even though I kind of like Uber, I just can't understand why I would want to buy it at these prices when I could instead buy larger, safer, and much more diversified companies like Google, Tesla, GM, or even Baidu, most of which are even cheaper by comparison too, and yet I get so much more in return. So unfortunately, I'm gonna have to rank Uber pretty low here at number 4, because as much as I might like it, I just can't envision myself ever buying the stock. Moving on to purchase number 2 though, we actually have a stock that I do own myself and that I've been a really big fan of in recent years, and that is Broadcom, ticker symbol AVGO, which BlackRock increased their position on by 10% in the quarter as they've slowly been building it up larger and larger over time, now amounting to over $38 billion. And yeah, like I said, I do love this one. This is not only a great business and stock on its own with leadership in custom computer chips for other businesses, as well as many different software and service expertise, especially in cloud computing and cybersecurity, which was only further boosted by their massive acquisition of VMware. But this is also one of the best dividend growth stocks as well, having now increased their dividend for 13 years in a row with a solid growth rate of nearly 20% and a pretty good payout ratio below 50% too. However, the downside is that the yield has fallen to just about 1.6%, which is a direct result of how much the stock has already risen. Anytime a stock price goes up, of course, it tends to drive down that dividend yield. And as you can see on this chart here, their stock price has not only doubled in just the past year alone, but it's also more than quadrupled in the past 5 years too. On the bright side, I actually think the valuation isn't nearly as bad as you might expect, with a PEG ratio that is still somehow cheaper than the sector. And yes, unlike Uber, I do actually take Broadcom's PEG ratio much more seriously because they've really proven that they can raise their profits over time and consistently too. But even just their forward PE ratio is also just about the same as the sector as well. So while it's certainly not a cheap stock by any means, I also wouldn't consider it very expensive either. It's kind of just like a fairly valued stock in my opinion. But regardless of all of that, Broadcom really is just an extremely well-run company with absolutely fantastic financials where their profit margins have also been soaring over the years. With last year, for example, seeing their net income margin grow to almost 40%. And even looking ahead, sales are still expected to rise by double-digit rates in each of the next 2 years too. So while I'm not necessarily buying more of the stock at the moment, I still love to own it long term, and I might even want to add some to our community portfolio soon too. But either way, it is miles ahead of Uber in my opinion, and it easily gets the number 2 ranking here until I see what else is on this list. Well, moving on to purchase number 3, we actually have a stock here that I happen to love even more, and that is the e-commerce giant Amazon, ticker symbol AMZN, at about 2.4% of the portfolio and worth a whopping $95 billion, which BlackRock increased their position on by another 2% in the quarter. And yeah, I totally agree with this move here by BlackRock. In fact, I think anyone is more than justified for buying Amazon stock at basically any moment. Yes, the stock has risen by a lot already, up over 800% in the past decade to now trading near an all-time high. And no, the valuation is not cheap on practically any metric you look at. But my argument is, who cares? Like, seriously, I'm not joking. Like, who cares? Because first of all, Amazon has never been a cheap stock to begin with, and yet that's never held it back. Which even here, it's not as crazy as you might think, with a PEG ratio that is only slightly higher than the sector and a forward PE ratio that is almost 80% cheaper than their own 5-year average as well. That's actually pretty reasonable considering the unbelievable business that you get in return, where Amazon has almost doubled their revenue in the past 5 years to more than $500 billion, and yet somehow they are still growing by a double-digit rate. I mean, it's absolutely crazy when you look at these numbers. Their EPS growth is also at a double-digit growth rate, and the stock price is much lower than the average analyst price target. It's actually pretty close to the lowest. And overall, this is just one of the most ambitious companies out there that is always trying to enter and really take over new markets, oftentimes subsidizing them until they gain enough subscribers to start charging new fees, which Amazon Prime Video is a perfect example of. They basically offered it for free to anyone that had an Amazon Prime subscription. I guess that's not really free, but they added it on. And by the way, that's at hundreds of millions of paid customers, by the way. And then most recently, they started to introduce commercials on Prime Video, unless you're, of course, willing to pay even more per month. So I just can't believe how much the world really fails to see what I've been seeing all along and what I've been saying in a lot of my videos, which is that Amazon's lack of care for immediate profits is actually their biggest strength, because they take their time, they hook you in, they subsidize the parts of their business that, you know, are maybe not as profitable with other parts that are profitable, like cloud, and then they dominate these new markets while everyone else is panicking over profits and valuation. I'm not saying that it would work for most other companies out there, but it does work for Amazon, and I'm giving it the #1 ranking because of that. That will, however, bring us now, though, to the final two purchases. And if you thought Amazon was big, well, stock number 4 is an even larger company by market cap, and that is the smartphone giant Apple, ticker symbol AAPL, which BlackRock increased their position on by just a measly 1%, but it's now sitting at over $200 billion, so more than double the size of their Amazon position. And to be honest with you, I don't really agree with that. Now, don't get me wrong, I do love Apple stock myself. In fact, I'm invested in it too. And as the second largest public company in the world at close to $3 trillion, they've certainly proven to be a great leader, with also doing gigantic financials on some really strong margins, usually doing north of $400 billion in sales, with about a quarter of that going straight to net income profits. But as incredible as all of that is, their growth has been stagnant for years now, with this year in particular also expected to be about flat before they finally return to a mid-single-digit rise in sales next year. Granted, at their already massive size, it's not a very big concern. Plus, the valuation isn't even as crazy as you might think, with forward PEs that are somewhat close to the sector median. However, their PEG ratio is pretty high, with the stock itself up nearly 900% in the past decade, which I'm just not really sure that it completely warrants that kind of a rise given the lack of growth that we've been seeing. Now, still, I do continue to invest in Apple for the sticky ecosystem, with already more than 2 billion active devices out in the wild, the rise in software sales that are higher margin, their future potential with things like foldable phones, and wherever else they really choose to invest their massive cash pile of over $162 billion, which is larger than just about anyone else out there. And so with all of that in mind, I do still think that it deserves the #2 ranking here, but I would prefer Amazon much more at today's prices. But finally, guys, we have the last purchase of the list, which is also the largest position out of these 5, and that is none other than Microsoft, ticker symbol MSFT, the largest company in the world right now at over a $3 trillion market cap, which BlackRock increased their position on by just under 1% in the quarter, bringing it up to over $200 billion and worth over 5% of the portfolio. And yeah, what's not to like here? Microsoft is actually my own largest stock in my own portfolio, and there's good reason for that. The financials are some of the strongest I've ever seen, with unbelievable growth for their size, doing over $200 billion in sales last year, where a whopping $72 billion of that went straight to the bottom line, which is a very strong net margin of around 35%. Especially considering how much they invest back into the business every year, which, by the way, has clearly been paying off for them, especially in cloud computing and artificial intelligence, which they've been implementing into practically every part of their business now. To give you an example of that, their new AI service called Copilot has already been integrated into GitHub, which is the leading code developing and sharing platform of the world, where this new AI service is helping developers with all of their coding needs. And I think you'll continue to see more and more examples of this in the future, where AI just makes Microsoft services even more attractive, while also adding more recurring subscription revenue too. Unfortunately, the stock has already risen by nearly 1,000% in the past decade, which, it's going to leave their PE ratios pretty high, north of 30. However, the PEG ratio isn't too bad at just around 14% higher than the sector, which I do feel that you really do get what you pay for in this scenario with Microsoft stock. Now, when you're talking about revenue growth, it's also still around 15% a year going forward, with even higher EPS growth as well. And that's despite their already gigantic size. And because of that, I just think Microsoft is one of those stocks that, pretty much anyone, or I should say everyone, should probably own at least a piece of. And I'm going to rank it number one because of that. Although I will say that Amazon is almost tied with them in terms of how much I love both of these companies right now. But yeah, I think I'll keep the rankings here where they are. And overall, I will just say, guys, that I happen to really like this quarter from BlackRock. The previous quarter was a little more boring in my opinion, but this one, I see really solid choices here. Now, granted, these aren't, very young and more exciting companies that you might want to see in a YouTube video, but for a company like BlackRock, I think it makes total sense. Stocks 1 to 4 are just absolute solid companies that you could park a lot of money in, which makes sense for a company like BlackRock. But I'm also invested in all 4 of those myself too. So I did like this quarter, and I agree with it overall. But I'd love to hear what you all have to say down below. What do you think? And do you own any of these stocks? And do you agree or disagree with anything that I had to say, any of my opinions? I'd love to hear your thoughts down below. But thanks again for stopping by, my friends, and thank you for all your support. It means so much to me. I hope you're all doing well, and I will catch you in the next video. All right, take care, everybody. Bye-bye.